Long-term decisions typically involve longer time horizons, higher cost larger sums of money, and require a lot more information to be collected as part of their analysis than short-term decisions. The investment of funds into capital or productive assets, which is what capital budgeting in terms, meets all of these three criteria and therefore is considered a long-term decision. The usefulness of capital budgeting decisions can have a long-term effect on the firm and are thus to be made with considerable thought and care. There are three things you should remember about capital budgeting decisions, and these include: a capital budgeting decision is typically a go or no go decision on a product, service, facility, or activity of the firm. That is, whether we accept the business proposal or we reject it. A capital budgeting decision will require sound estimates of timing and the amount of cash flows for the proposal. And lastly, the capital budgeting model has a predetermined accept or reject criteria. The payback period. This method, which is the easiest to interpret and use, simply tries to determine the length of time in which the investment pays back its original cost. If the payback period is less than or equal to the cutoff period, the investment would be acceptable or vice versa. Thus, the main focus is on cost recovery and liquidity. The payback period does have three major flaws. One, it ignores all cash flows after the initial cash outflow has been recovered. Two, it ignores the time value of money. And three, it does not take into account the risk of cash flows. A discounted cash payback period calculates the time it takes to recover the initial investment in current or discounted dollars. Thus, it takes into account the time value of money by adding up the cash flows that have been discounted to the time zero, using the appropriate hurdle or discount rate, and then measuring the payback period. It is still flawed in that the cash flows after the payback period is ignored. Net present value is applied by discounting all cash flows from the project back to the time zero using the appropriate discount rate. A positive net present value implies that the project is adding value to the firm's bottom line, and therefore, when comparing projects, the higher the net present value, the better. The net present value approach can be evaluated independent as well as mutually exclusive projects. A choice between mutually exclusive projects arises when there is a need for only one project, but both projects can fulfill that need. And two, there is scarce resources that both projects need. And by using it in one project, it is not available for the second. Since the net present value rule considers whether or not cash inflows that have been discounted at the relevant cost of capital outweigh the cash outflows, Since the net present value rule considers whether or not cash inflows have been discounted to the relevant cost of capital outweigh the cash outflows from the project, the higher the net present value would be preferred to the lower net present or negative net present value, making your decision clear cut. So basically, what is being said here is that once we compare the net present values in mutually exclusive projects, the project with the higher net present value is the more attractive project. The internal rate of return is the discount rate which forces the sum of all discounted cash flows for the project to be equal to zero. The decision rule would be applied as follows. If the internal rate of return is higher than or greater than the hurdle rate, it essentially means that it would be accepted. If the internal rate of return is less than the hurdle rate, then we will reject the project. So if the project's internal rate of return is higher than the discount rate, this simply means that the net present value would be greater than zero as well. The internal rate of return is measured as a percent, while the net present value is measured in dollars. The net present value decision model indicates that if the net present value is zero or greater, we would accept it. If the net present value is a negative number, then we would reject it. So the difference here is that the net present value will give you your return in dollars, where the internal rate of return will give it to you as a percent. In most cases, the net present value criterion and the internal rate of return approach leads to a consistent decision. That is, if a project has a positive net present value, its internal rate of return will exceed the hurdle rate or the required rate of return, making it acceptable. Similarly, the highest net present value project would generally have the highest internal rate of return. However, there are some cases where the internal rate of return method leads to ambiguous decisions or is problematic. In particular, we have two problems with the internal rate of return approach. There are multiple internal rate of returns and an unrealistic reinvestment rate assumption. If the cash flows have multiple sign changes during the project's life, this leads to multiple internal rate of returns. And therefore, ambiguity, I can never say this word, ambiguity is as to which one is correct. In such cases, the best thing to do is to draw a net present value profile and select the project that has a positive net present value at our required discount rate and vice versa. Now, based on the models covered in this week, we have several methods. We have the payback period, which is a simple and fast, but economically unsound. It does ignore all of the cash flow after the cutoff date. It ignores the time value of money, and it does not account for risk. There are discounted cashback periods incorporate the time value of money, but still ignores the cash flow after the cutoff rate. Third, we have the net present value, which is economically sound and properly ranks projects across various size, time horizons, and levels of risk, without exception for all independent projects. The internal rate of return provides a single measure, which is the return, but has the potential for error in ranking projects. It can also lead to incorrect selection when there are two mutually exclusive projects or incorrect accept or reject of a project with more than one single internal rate of return. The modified rate of return is in general corrects for, for most of, but not all of, the problems with the internal rate of return and gives a solution in terms of a return. The reinvestment rate may or may not be appropriate for the future cash flows, however. And lastly, the profitability index incorporates risk and return, but the benefits to cost ratio is actually just another way of expressing the net present value. Cash flows measure the actual inflow and outflow of cash, while profits represent merely the accounting measure of periodic performance. It's important to remember that the firm can spend its operating cash flows, but not its net income. So some firms have net losses due to high depreciation write-offs and yet can pay dividends from cash balances, while others show profits but may not have the cash available. A comprehensive capital budgeting analysis requires the estimation of initial and future incremental cash flows that are likely to result over the productive life of a project. In particular, the following four steps are typically involved. The first is to determine the initial capital investment for a project, which includes the purchase cost plus installation plus initial increase in working capital minus the after-tax salvage value from the disposal of old assets, if any. Then the estimation of the annual capital cash flows, incremental, generated by the project, ignoring sunk costs and including erosion costs and their side effects. Next, the determination of the change in the net working capital, which is usually an increase at the beginning and a reduction at the end. And then finally, the evaluation of the proposed projects using the appropriate discount or hurdle rate used in either the net present value or the internal rate of return approach. Now there are three broad approaches to financing a company. There are primary three broad sources of financing the company, financing that a company can avail for raising capital. We have debt, we have common stock, and we have the preferred stock. Each capital component has its own risk and return profile and therefore its own rate of return required by the investor to provide funds to the firm. The firm estimates their weighted average cost of capital by multiplying each component weight by the component's cost and summing up of the products. The weighted cost of capital is essentially the minimum acceptable rate of return that the firm should earn on its investments of average risk in order to be profitable. So in other words, the weighted cost of capital should be used as the discount rate when computing the net present value or the criterion that must be exceeded when using the internal rate of return for capital budgeting decisions. In order to determine the firm's weighted cost of capital, we need to know how to calculate the relative weights and costs of debt, preferred stock, and common stock of a firm. The cost of debt is the rate the firm will have to pay when they borrow money from the bank, finance companies, and other lenders. It is essentially measured by calculating the yield to maturity on the firm's outstanding bonds. The yield to maturity on the outstanding bonds based on the bond's current selling price tells us what investors require for lending the firm their money in current market conditions. However, if a firm were to go ahead and issue new debt, which is typically what happens when a firm expands or grows, it would also have to pay some transaction costs to the investment banker and thereby receive lower net proceeds for each bond. The lower the amount the firm gets to keep from the sale, the higher its cost is going to be. Accordingly, to correctly estimate the cost of capital for inclusion in the weighted average cost of capital calculation, we must adjust the market's price by the amount of commission that would have to be paid when issuing new debt, and then calculate the yield to maturity. The preferred stock component. Since preferred stockholders receive a constant dividend with no maturity date, its cost can be estimated by dividing the annual dividend by the net proceeds after the flotation costs per sale of the preferred stock. Lastly, the equity component. The cost of equity is essentially the rate of return that the investors are demanding or expecting to make on money invested in the company's common stock.